to me, there's two things that come out of a kind of pre-war mindset. An urgency, right? We haven't had this urgency. We've been talking about the lack of rare earths, critical minerals for years. We've been talking about, yes, moving to solar or wind's fine, but it's not going to create the backbone. We're not doing enough fast enough. And we watch China kind of outpace us. So I think there becomes an urgency. And the other part of this is almost a sense of sacrifice. Will we sacrifice something? And I think in our case, some of that sacrifice is going to be no more cheap goods or fewer cheap goods, right? We're going to be paying more. And I think we're going to have to sacrifice some of our regulations that we put in place, right? Things that we felt were very important, maybe like Bill Gates thought were very important, get deprioritized when you realize, ooh, crap, if we focus on only that and China goes here and beats us, this won't matter because we lost to China.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Wall Street fears of Trump's tariffs and trade wars are greatly diminished these days, at least by the stock market, which has been flirting with new highs of late. Now that we're nearing the end of the year and a resurgence of inflation hasn't materialized, and new trade deals have or are being finalized with many of America's largest trading partners, including China too now it seems, an important question is starting to emerge. Will the economy start experiencing tailwinds soon from the administration's policies? To discuss, we're fortunate to welcome back to the program Peter Tchir, head of macro strategy at Academy Securities. Before we get started, folks, just be forewarned that Peter's audio had a slight issue in the first part of this interview. We fixed it about a third of the way through, and it was fine after that. All right, with that caveat out of the way, Peter, thanks so much for joining us today.
Thanks a lot for having me back.
Really glad having you back, Peter. Look, lots to talk about here and a lot going on this week. So why don't we just start dialing through the list if you don't mind. We are speaking the day after the FOMC came out with its latest release and Jerome Powell had his most recent press conference. The Fed pretty much delivered as expected. It did another 25 basis point rate cut. It announced that it will be ending quantitative tightening starting on December 1st. And I guess the only really maybe major notable takeaway from it was that Powell took pains to say, hey, look, a rate cut in December isn't baked in the cake. He's not saying that they're not going to cut. He's just saying if you're putting all your chips on them cutting, you should think twice about that. So curious just to hear in general your reaction to all this.
Yeah, I think he tried his best to, say they're looking, it's very difficult for them to do much without data. They're not sure where they say the economy is. I think in the end, the market's just reading through a lot of this, knowing that by February, March of next year, it'll probably be a very different makeup on the Fed. And they're probably going to cut to get us down to 3%, maybe under, almost no matter what the economic data is. So I think that's kind of why we had that brief dip in the markets and stocks as he was speaking, but we kind of quickly retrenched that. I think anything he says, he's a little bit of a lame duck now. And if people really thought, okay, wow, this might delay it by 6 months to a year, that would be a big deal. If it's going to push off the cuts 2-3 months, I just don't think anyone cares that much. And it's going to really come back to what our earnings look like, what's the cumulative effect of a lot of our policies, and where are we going with China and trade.
Okay, so earnings, policies, and trade. Why don't we tackle those in order? So we had the earnings over the past couple of days for a lot of the major Mag 7 companies. I think there's still two more big announcements later today, Apple and Amazon, I think. But we just got Google and Meta and one other big one I'm blanking on. Pardon me? Microsoft, you're right. Mixed so far, right? Google, I think, was up a bit. Microsoft was down a bit. Facebook was actually kind of down big because all of these companies are having to spend much more so than they used to have to in the past in terms of CapEx, as all this as part of this whole AI build out. Now, we just had Nvidia cross $5 trillion in market cap this week. No huge surprise because everybody's spending their CapEx money on Nvidia's chips. But I guess my question is at what point, given the just stratospheric valuations that these stocks are reaching. And by that, I don't just mean all-time high prices, but I mean very stretched multiples, multiples to earnings, multiples to sales, et cetera. Um, at what point do we say, hey, look, unless earnings really start growing tremendously, these current market valuations aren't supported? Um, or maybe somebody just looks at this and says, "Hey, maybe this is kind of overblown. Maybe we pulled too much of tomorrow's valuation into today, and this is going to take years longer to manifest all the incremental revenues we think it might have." So I guess where I'm going here is from an earnings perspective, what level of concern, if any, do you have about today's prices for the AI high flyers?
Yeah, I'm a little bit worried, not necessarily in terms of earnings. I think they're going to continue to grow, but will they grow anywhere near the pace that people have priced in? What's interesting to me, it looks like on Meta, at least for the first time, people are saying, well, it's great that you spent a lot of AI, but did we get enough benefit for that spend? Right? It was
Right.
like for a little while, it was almost free money when a company said, I'm going to spend X billion on AI, and your stock increased 2X or multiples of X in terms of valuation. So you're not getting that for the first time. It could be a one-off. It could just be, a weird thing. But I think that's the sort of thing a lot of people will be looking to. Is this a signal that people are starting to doubt whether these companies can really grow into the multiples they have if they keep spending at the current pace?
Yeah, and I don't want to come across as a doubter in AI that the technology doesn't have real benefits and that it probably very well be super transformatory or transformative the way the way the internet was during the dot-com boom. Um, but it is this question of you're pricing these things for perfection or better than perfection. Can earnings really realistically keep up with all this? So, you know,
And I would add maybe even, I feel like we're also pricing this to that the U.S. will remain clearly in the lead, and that China is going to be way behind, and that China is kind of on its knees, almost begging for Nvidia chips. I'm not sure that's the case, right? Xi didn't really seem to bring up Nvidia yesterday. Trump said they didn't really discuss Nvidia chips. You've seen a lot of kind of interesting announcements coming out of China in terms of what they're trying to do in AI and data centers. That they're trying to be more efficient. They're using cheaper chips, less electricity to get potentially very good results. I think trust but verify with everything coming out of China.
yeah.
But we seem to kind of ignore that you've got this behemoth who's proven themselves to be pretty good at a lot of different things. And I feel like we're kind of completely ignoring the risk that whether it's China or even maybe domestically, someone turns the industry on its head, right? We've been evolving so rapidly. Some of these companies we barely heard of 3 or 4 years ago, OpenAI, I've got to admit, wasn't really on my radar screen certainly 5 years ago. Now it's this dominant entity potentially doing $1 trillion IPO. What else is out there that we might not have heard of that disrupts this apple cart? Because one thing I does seem to me is the pace of innovation is like cycling really rapidly. The life cycle of chips seems very low. The life cycle of technology, you turn around and people are talking about fusion, these other things. The technology just is amazing how quickly it's growing, and it's unclear whether even today's great winners are tomorrow's great winners.
Can I ask you a question about the technology there? So in the dot-com boom, and I think in most sort of previous technology transformative booms, the pattern seemed to be you overbuilt at the start, right? So there was a mania, a ton of capital came into the space, and we built a ton of railroad lines across the nation, or we built a ton of dark fiber, across the nation, across the world. And then over the ensuing decades, uh, there was there was kind of a die-off as folks realized we overbuilt initially and full demand wasn't there. There was a bit of a die-off, but the new companies came in or the survivors, picked themselves back up. And then eventually they used that excess capacity and filled it out over time. With AI, I've heard it said that it's maybe not quite like that because the chips kind of have a shelf life. Um, and partially because the technology is getting so much better that a chip that was made a year ago is kind of a snoozer compared to a chip that's coming out now. Is there any sort of valid worry there that if we just build out a ton of data centers with today's chips, they might not have the same value 5 years from now?
Yeah, I think there's some degree of risk on that. I also think the flip side of this is electricity was never such a major component of fiber. You look at the electricity demands that are slated to go online, needed to go online if we're actually going to drive data centers and AI at the pace that people are talking about building them out. I don't know that we have that. I don't know how successful so far we've been doing and planning around that. I think There's all sorts of efforts. You've all of a sudden seen the government launch a slew of initiatives to kind of get nuclear up and running, but that's a 5, 7, 10, 12-year sort of time horizon. We're going to need all sorts of electricity. You're seeing a little bit of backlash in various places, like even in Northern Virginia, is people complaining a little bit about, hey, we're getting brownouts. We're not seeing the electricity that we need or at the price that we need because so much of it's being going into some of these data centers. So I think there's all sorts of things that make this even more complex than the past. As you said, what happens if you build out all these data centers on this sort of technology, and 6 months down the road, a year down the road, it becomes very apparent, wow, this other technology is really the way to go. And are these data centers still relevant? Are we building in the places we need to go? I think we're going to face real competition from the Middle East, where the Saudi Arabias are kind of hands up saying, give us the chips. We have solar energy. We have cheap fossil fuels. We can desalinate water if we need to, do the cooling. We will do all of this. And so I think it feels to me like, we're still assuming that we are the sole providers of this, that we're way ahead of everything, which is true. I'm not sure that that's going to continue. So I feel like these valuations, maybe we'll see much bigger valuations down the road. Maybe we're going to see them in the next few weeks, but I feel it's all a little bit susceptible. Though I will say this, Trump, yesterday Nvidia popped or 2 days ago, Nvidia popped on Trump talking about their super duper chips and how China might get some. And they didn't really sell off today on the back that they said Xi and him didn't talk about it. So there is still this kind of nature. So I wouldn't step in front of that train, but I have a very low to minimal exposure to that kind of Mag 7 type trade. I'd much rather own the energy providers. I want to own what we've been calling production for security, where this administration, I think, is going to go looking at chip manufacturers. So I do own Intel. I continue to own Intel. I think Trump is going to do what he can to support Intel. It's his nature. It's his style. I'm looking for who are going to be a national champion, maybe in the energy space, who we decide to back, right? Westinghouse just got this big investment. Go ahead with nuclear. So I kind of like playing that angle. I don't, some of those stocks are a little bit frothy, but I think there's a lot more, you're not going to get necessarily the same pops, but I don't think you have the same downside. So I kind of like those areas. And I think that's where the growth comes, is we really focus. And I was a little bit worried that we have some great deal with China. I think we have a 1-year runway to get as much of our act together as we can before we're back at the table with them.
Okay, I'm going to dig into that very deeply right now. Real quick, folks, I just want to note, we had some audio issues with Peter early on. We're going ahead with the audio solution we have here. Hopefully it's good enough for you. Just know that I think there's sort of some storms going on in his area and some other things like that. So just soldier through the audio with us. All right, so Peter, real quickly, can you just expound for folks a little bit more to make sure they understand when you talk about production for security and how that is a trade strategy of yours and your firm there, Academy Securities?
Yeah, and I'm going to take it a step further. I think what we've been calling this production for security is really going to become the new ESG, and kind of globally. And I think you look at what we need to be sustainable, and I think we took a very narrow definition of sustainability. And it'd be nice to have things that are completely renewable. It'd be nice to have very low carbon footprints. And I think what's gone on certainly in the last year with kind of China threatening on rare earths and critical minerals, in terms of if we want to be number one at data centers and AI, we need this electricity. And so I think we're taking a step back and saying, both as a nation, I think it's going to make it to the corporate and investment level, just like ESG did. We're saying, well, what of this do we need to produce ourselves to be somewhat secure in our lifestyle? How much do we have to produce on our own? How much can we produce with close allies? And then how much can we buy on the open market from people we may or may not trust very well, but they're the cheapest price? And when you look through the sustainability as it was kind of defined before, that wasn't part of the equation. So I think people are going to be much more careful about supply chain. Hey, what does my supply chain look like? And if I am invested in Vietnam and Thailand, but both of those ship right beside China, maybe I'm not that diversified there. So I think people are going to take a hard look at anything that's obvious at the government level. We're going to take a hard look at anything from defense spending to the rare earths and critical minerals, and not the rare earths and critical minerals themselves as much as the refined and processed version of those. Electricity production or electron production, how much we have to do of that. Chip production. I think you're going to see some of this in pharma. You're going to extend this on out, road, space, and we're going to see levels of investment to make sure that we can do a lot of that on our own and are somewhat dependent maybe on our close allies and very independent of other countries. And I think that's going to go through the entire corporate ecosystem, and it's going to be kind of a new ESG type mentality of what do we need to produce here? I think Europe's going to be behind the curve. but even they, I think, are going to start seeing the value of this, right? You can't be an industrial power. You cannot be in data centers if you're dependent on someone else for all your electricity. And it's kind of this wake-up call, and it sounds like Bill Gates is all of a sudden, downplaying the, imminent doom from electricity production of various forms. So I think this is all fitting, I think, a multi-year investment timeline that we haven't thought about before. And I do think there will be, ProSec or production for security committees where there were ESG committees, or maybe the ESG committee will evolve to that. But I think if you think about sustainability a little bit more harshly, it has to include those things. And if you're not doing those things, are you really a good governance? So I think I really see this as going aggressively. I think some states will embrace it. Some states will fight it tooth and nail. But to me, this is the direction we're headed.
All right. Well, look, I got a lot to say in response to that. First, real quick, I just want to let folks know that we took a break after the last answer Peter just gave to see if we couldn't troubleshoot the audio. I think we've got a better solution in place right now. So thanks for sticking with us, folks. All right, Peter, when you talk about ProSec kind of being more like a new take on sustainability, I sort of think of it that way as sort of like sovereign sustainability, like the things that governments or nations need to make sure they do well to kind of stay around. And so that could be, resilience, like resilience of supply chains. It could be, national security priorities. To me, this kind of goes hand in hand. I don't know if you're familiar with Michael Every, the global analyst at Rabobank. But for many, many years, he talked about how mercantilism was sort of the way that the world worked, and that this era of globalism that you and I and most of the viewers grew up in was actually kind of the historical aberration, and that things were much more likely the pendulum was much more likely to swing back to mercantilism. We've sort of seen that happen on steroids in recent years. And basically his definition of mercantilism is more or less, nations are going to do what nations have got to do. And it's not just going to be free markets and global free trade. It's going to be, hey, I might starve this one part of my economy to overfeed this other part of my economy, because that's where our national interests lie right now. You're nodding as I'm saying all this.
Yeah, I think that's perfect.
Good. And by the way, if you don't know Michael Every, you definitely should get to know him. I think you guys would really enjoy just sharing notes with each other. Your point about Bill Gates, I thought was really interesting too. So, you've probably seen the same chart that I've shown on this channel a couple of times, which shows America and Europe's electrical production capacity for the past, I don't know, 50 plus years. And it's pretty much a flat line. I mean, slowly growing, but pretty flat. Then you see China's, and China's is almost vertical, right? And it dwarfs the US right now. So that seems to have really gotten, America's, or the attention of our ruling class right now. We've got, all hands on deck. They're prioritizing nuclear, all this stuff that was just languishing. And of course, they're realizing, look, if we're going to try to win the AI race, we got to have as much, if not more, cheap electrons than China does to win it. So that's going to be a big trade. It sounds like that's already one of the things that's kind of on your radar, but I'll let you talk in just a minute. But yeah, I noted the same thing you did with Bill Gates, where maybe it's just coincidence, but I don't think that it's coincidence that he would have this sort of reversal on the criticality of climate change if Microsoft if its future wasn't so dependent upon the build out of this new energy grid, which of course is going to need a lot of fossil fuel, as you were saying, to get built out and to be maintained.
Yeah, no, and I think the one thing you talked about where you might need to starve one part of the economy to do something with another part of the economy, it resonates with something we've been talking a little bit about. And I have the pleasure of working with Spider Marks, who's on CNN a fair bit. He's a retired general. And Academy, we've got 30 retired generals, admirals, some CIA people I get to work with. And he's been talking about that we're moving to a pre-war footing. And for me, that's fairly interesting. And what he means by pre-war is really even between World War I and World War II, we are caught by surprise. But post-World War II, we lived in a post-World War or post-war economy, right? People were very comfortable. We built up things like United Nations to prevent another war. And then after we had the demise of the Soviet Union, we really lived in this peace dividend, right? Europe stopped spending on defense.
Yep.
Everyone kind of became very altruistic. And so the three things about a pre-war economy, I think, that are really important. One is you only do a pre-war economy to prevent war. right? If you become very good at it.
And starting up a pre-war means like we're going to be kind of like on DEFCON 3 as our status quo. Like we're just going to be expecting a war at some point. We're prepared for it.
Right, right. And it's kind of like deterrence, right? Okay, once we realize that, I think that feeds naturally into this, mercantilism or the production for security. And to me, there's two things that come out of a kind of pre-war mindset. An urgency, right? We haven't had this urgency. We've been talking about the lack of rare earths, critical minerals for years. We've been talking about, yes, moving to solar or wind's fine, but it's not going to create the backbone. We're not doing enough fast enough. And we watch China kind of outpace us. So I think there becomes an urgency. And the other part of this is almost a sense of sacrifice. Will we sacrifice something? And I think in our case, some of that sacrifice is going to be no more cheap goods or fewer cheap goods, right? We're going to be paying more. And I think we're going to have to sacrifice some of our regulations that we put in place, right? Things that we felt were very important, maybe like Bill Gates thought were very important, get deprioritized when you realize, ooh, crap, if we focus on only that and China goes here and beats us, this won't matter because we lost to China.
Right.
So, and this takes us back, right? There's been encouraging moments. We put people on the moon. We did the Manhattan Project. When the nation kind of unites around this shared goal, there is something to be done. So I think there's that potential.
Okay, so for the people that are listening and saying, okay, yeah, this makes sense to me, how does the ProSec strategy then transform into an investment strategy? And you mentioned fossil-based energy as a component, but right now, what are you looking at in a ProSec portfolio?
Yeah, so there's kind of three pieces I'm looking at right now, and it's kind of evolving relatively quickly. Some of it, for lack of a better word, I'll call the lottery ticket type thing. You're looking for small companies, maybe sub 10 billion, that are involved in either nuclear, the processing, refining of rare earths and critical minerals, maybe something in biotech that becomes interesting. Biotech's just hard because there's so many things, whereas I think the rare earths and critical minerals are a bit easier. Someone who has really interesting electrical technology, a little bit in the chip industries. I think you can look to defense. Who's good in the drone space? Is there someone who can do icebreakers for the US? Places that are going to really become national security. And so you look for a slew of these, small ones, some of whom have IP, maybe some intellectual property that they can use. So I want to own kind of a small subset of these, and you're going to get some wrong. They're very volatile in where they are. Some like an MP have already been bought. That was probably a great example. I did not own that one. LEU, which is one that I've owned off and on. I currently don't. You can look at some of the nano reactors. So there's NNE, which I don't own, SMR, which I own a little bit. I find I have to trade these a little bit because they are very volatile, but that's kind of a lottery ticket. And then I think you move to trying to identify national champions, right? So you kind of had US Steel, right? I'm not sure exactly where that stands, but I'd kind of categorize that at the national champion sort of level. Trump allowed them to be bought by Nippon Steel, but the US has some sort of involvement. Intel to me, right? That's going to be our national champion for trying to build chips out here. It's going to force other companies. I want to continue to own that, right? Just by his nature, Trump likes to win. Trump views that he, on behalf of the US people, owns 10% of this company, and he will do a lot, I think, to try and get that business going. I think the stock's above 40 last time. I think there's more room to run, and on a market cap basis, it's still tiny compared to the other chip producers. And I'm trying to figure out, will there be, Westinghouse might qualify in this? Will there be one of the big energy companies who says, we're really going to work with you to expand what we're trying to do. We're going to force an investment on you, or you're going to offer you investment that you can't refuse. So that's going to be part. And then I'll circle back to what I'm trying to avoid doing. I looked at a few of the rare earths and critical minerals ETFs, for example. And one I happened to pull up, the second largest holding was China something. So when you're looking, if you want to go ETFs, I do think you have to spend a bit of time looking at who's the underlying. And I'm trying to prioritize companies that are either 90, 100% or close to 100% US focused. 50% US focused with maybe in Australia, Canada, close ally sort of element, maybe even in Argentina where Trump seems to be very involved. I think those are okay. Anything that really smells of China or in India or a real foreign involvement, I don't think those are going to benefit the same way. Yes, they'll benefit from the commodities or the refining doing well, but they're not going to get that impetus from the US government. So that's been one of the things I've been asked a lot of questions like, ooh, why do some of these, rare earths and critical minerals ETFs or the uranium things not perform as well as some of the underlying? And that's because some of the large companies we're not really US, and Trump is not going to go out of his way to support a company that's not primarily US, and he's going to go out of his way, I think, to make it difficult for a company that is more Chinese focused.
Yeah, got it. And of course, that certainly fits under an America First banner. So I'm curious, do you have strong feelings, strong opinions on the U.S. government taking equity stakes in U.S. companies, or do you not care? You're just like, look, I'm just playing the market as we have it, and that influences stock prices.
Yeah. So let's see. That's a tough answer or question to answer. I think in an ideal world, I would like to have seen some sort of guidelines put in place for what happens when the U.S. government takes a stake. How do we behave? What are our roles? How passive are we or not passive? So in an ideal world, I think I would have liked to see corporate governance put in place before these investments took it. I'm not sure I'm comfortable with the way it's playing out. I don't think that it's necessarily fair that the president can, kind of pick winners and losers and maybe
Yep.
force people to do business with or without, these companies that we've invested in. Having said that, for now, I'm going to try and take advantage of that because I can't figure out how to stop it. And I'll take go a big step backwards though. The CHIPS Act, for example, right? That was designed in theory to help, the chips companies. One, it was going to give grants to these chip companies. So I would actually rather have, as a taxpayer, us get the benefit from these investments going well than us kind of giving this money as grant money and the current shareholders doing well and they just get our money. So I think kind of the thought of an investment, if done more organized, would be really good and ideal. And a lot of those CHIPS Act money did not actually get taken out, which is why Trump had the money around to get this Intel investment. And part of that was because we were trying to force a lot of policy on those companies. So we were forcing different types of policy, but we were forcing who they could hire, what sort of daycare they had to provide on site. There are all sorts of strings attached to getting that CHIPS Act money. And I'm not sure that's any better or worse. In fact, maybe it's slightly worse than what we're doing. So, I don't think we're in a perfect solution. I would have liked to see guidance, but I think it's hard to say that the CHIPS Act was any more fair and probably slightly more unfair if you're a taxpayer. And, I think this will evolve over time.
Okay. Do you expect to see more of this going forward? I think the answer is yes, but
Yeah, I really do. I think, they're starting to talk. Yeah, I think it was Senator Loomis it was more crypto that they're going to try and convert some gold into this $3 trillion war fund that they can buy crypto. I think in the end, they wind up doing this $3 trillion fund, but a lot of it actually just goes to investment in our industries, our corporations, much more so than a crypto. And that same mechanism where they try and convert some of the gold, sell some of the gold to create a sovereign wealth fund. Because that's the one thing that Trump is running out of right now is pockets of money he can use. He had the Intel money. There was some money around the Department of Defense, I think they used for the MP investment. I believe it's the Department of Energy had money for the LAC, which is Lithium Americas Corporation investment. So I think they are going to try and create a bigger sovereign wealth that will let them do this. And you're also seeing kind of, I don't want to say tricks, but the government is allowing nuclear projects to be built on military bases, right? The US government has immense say on regulation of federal land, which the military bases are on. So
people are saying, not in my backyard. So Trump's saying, okay, fine, we'll just put it on,
right.
military
It might
base.
be it might be in your backyard, but you now have no say over it. So, and again, that's not ideal. But again, I think we're on the early stages, and I think this kind of mentality is going to permeate a little bit more where everyone's got to say, okay, let's take a step back. And if mercantilism is right, I really like that idea and how she said Avery was from Rabobank was explaining it.
Yeah.
Like, if this is what we're going to do, what are we doing wrong in that respect? How do we fix this? And I also think it dovetails very nicely if you look at the attention we're spending now on South America, whether it's what we're doing in Venezuela or Colombia, which have their own issues, what we're trying, I think, to do ultimately with Mexico and our involvement with Argentina. We're taking our eye back onto, the North-South rather than, the Asia-Pacific. And the reality is it is much easier for us to be militarily and, Navy-wise in control of the region than it is in the Southeast Asia, where China's naval, has come. And as I've learned from a lot of our military experts, the tyranny of distance is real. The further you are from something, the harder it is for you to maintain any element of control. So I think we really are turning our attention back to this, North, South, Central America alliance.
Yeah, this sort of Monroe Doctrine, right?
Yeah.
Neo-Monroe Doctrine.
Yeah, I think the Monroe Doctrine, it gets a lot of talk, but I don't think anyone's done anything about it in a long time. And I feel like we're at the early stages again of adopting something like that.
Yeah, and I imagine that's probably part of why we invested in Argentina. right? Which is, hey, this is an ally. We want more of this type of model in the Southern Hemisphere
Yeah.
on our side of the map. And probably also why we're taking a harder line against places like Venezuela and whatnot, because hey, if we can kind of help regime change there, and I know I hate to say that because the U.S. really, my personal opinion, shouldn't be in the business of regime change,
Right.
but they'd love to get that, they'd love to get that problem resolved, but more importantly, I think they'd love to get China's influence out of there, and they would love to get that Venezuelan oil flowing again, but in our hemisphere.
Yeah, and I don't mean to be flippant. It'll probably come across a bit as flippant, but we've had this war on drugs for decades, and now it actually looks a bit like a war.
Yeah.
So, I think it's kind of interesting what we're trying to do. I think there's questions marks around some of this. And again, like a lot of things Trump has done on the economic side, I think he's doing on this side. We're pushing the envelope in terms of what's normal engagement, what's approved engagement, but it is setting a very different tone.
Yeah. So I'm going to say something, and I do not mean it to come out partisan. I'm not trying to make a comment in favor or against, but in business, there's this saying, if it doesn't get measured, it doesn't get moved. And there's a lot of things like you were sort of referencing earlier, Peter, that probably honestly for a number of different administrations, Republican and Democrat, we've kind of been navel gazers on a lot of this stuff. So rare earths is a great example. We talked forever about the fact that, hey, we're probably too dependent on other parties for this, right? But we just never really did anything. And hey, we've got rare earths, in North America, but we just really didn't prioritize, building our own domestic industry for that. And now, of course, we're scrambling, right? It seems like the new administration on a lot of things is starting to measure, right? How much fentanyl is coming into the country? We don't want it. Okay, let's start. Where are weak points? Okay, it's coming in by sea. Let's just start blowing up boats and hopefully diminishing that, right? Too many illegal aliens. Okay, what can we do to close the border? And all of a sudden there's zero basically border crossing, stuff like that. So they are using the measurement stuff. So let me ask you this: they're using that mercantilist playbook. How likely do you think this is to work? And if by working we mean advancing America first priorities of becoming a lot more resilient or sustainable as a sovereign nation?
One, I think it works much better if we go back to kind of working with our allies a little bit. So I think it's been encouraging a little bit, some of the deals they've been announcing, in this recent trip, but before that with Australia on some of the rarest and critical minerals, a little bit less, encouraging how we continue to fight with China, with Canada. So I think if we go back to, again, kind of my base market or benchmark is X percent, a fairly large percent has to be done domestically, but some part is going to have to be optimized with your allies and neighbors. And again, I think it was encouraging that Trump seems to be taking tariffs off things like bananas and coffee, which we don't really grow. I guess we grow coffee in Hawaii, but it's already very expensive coffee, so they're not going to be protected by tariffs anyways.
Yep.
So I see some of that change. I think to the extent we keep this friction on, it's a real race anyways. I think China right now is trying to gauge how much control they have over rare earths and critical minerals and the processed and refined versions, and whether it's worth them trying to choke that off or not, versus how quickly they're evolving their AI and data centers. They know they're ahead on electricity. They're behind on AI and data centers. They seem almost willing to say, you know what, we're going to avoid some of the Nvidia chips because we believe if we kind of force necessity on us, we'll grow this. So I think it's far from a done deal. Again, China is down to only we're representing only about 15% of China's trade, right? So they have done a great job diversifying away from us. I think we talked about this last time. My view has been that for the last 5 or 6 years, China has been transitioning from a made in China to made by China. And in made in China, they were making our goods and content for us to sell those across the globe. And now they're aggressively trying to sell their own brands, whether it's Huawei, whether it's BYD. And so they've made a lot of progress on that. They have really strong, bilateral sort of trade agreements or negotiations where a lot of the autocratic resource-rich nations sell their rare earths, commodities basically to China, and China in turn loads them back and sells them a bunch of their finished goods. And I don't think we should underestimate a lot of the emerging markets countries have been frustrated over the decades that they need the dollar to buy goods, that the SWIFT system is a very expensive and obtuse system to use, that we periodically use sanctions against them. So there's a lot of willingness, I think, for countries to explore trade with China. So I think it's far from a done deal. And the more erratic we appear, the more kind of we flip flop, the more we hurt our allies. Again, I have no idea why we seem to be in friction with India excessively, right? India would have been one of my first stops in trying to compete against China, is working closely with India. We seem to have gone the opposite. There's time for that. So I think it's very up in the air. And I think we're going to go through some hiccups as we go through this.
Okay, I think you just answered this question then, but it's the one I was going to get to next, which is, you have a bunch of um, current and former uh, both military experts and I just think political experts in your network there at Academy Securities. Um, as I understand it, and I am not a military or political expert, but that the reason why Trump did Liberation Day and kind of put trade war tariffs and trade pressure on everybody all at once was because he said, look, I gotta contain China, and I don't have a ton of time. And so I think I've got the best hand at the poker table right now. So I'm essentially going to do a global flex, and I'm going to basically call everybody. And you're going to kind of, you know, if you got a better hand than me, great, congrats to you. But I'm betting you don't. And if you don't, you get to kind of pick Team America or Team China. And so my question to you is I know it's messy, but net net, is he getting more people closer to our side through this, or is he pushing them further away and into China's arms?
There's a lot of debate for that. I would say we don't seem to see Peter Navarro on TV anymore. So
Hmm.
maybe he just listened to the wrong advisor at the time as well. So, Trump is not afraid to change who he listens to, who he takes, works
Yep.
with. It seems like Besson has become his right-hand person. I'm not sure whether Besson would advise this or not. Um,
But that said, he hasn't backed out of these trade deals either.
no, and I think personally, I'm of the opinion we probably could add a lot of these trade deals without going through the Liberation Day process. That I
Uh,
think we could negotiate with a lot of these countries. And the one fear that I have is the president, he loves deals, but you look in his company last time, it was thousands and thousands of LLCs, and everything's an individual property, right? And this golf course in Ireland, maybe there's 2 or 3 golf courses in Ireland that are tied together, but it's a series of individual transactions. And the world doesn't quite work that way, right? There's only, you know, 20 some odd countries slash regions that you need to deal with, and people have a memory. And it does not surprise me at all that everyone is coming around and shaking hands and doing deals, because what else are you going to do right now? But behind the scenes, what are they trying to do to alleviate themselves from this, potentially chaotic policy, right? It's, Japan played very nice. I believe she gave him a golden golf ball. They've done a lot of things to encourage him, but behind the scenes, what is the relationship? How long does it continue? What's going on behind the scenes? Is China able to use that? And I do think China is relying a little bit on the fact that we may just switch our attention to something else, because that seems to be the nature of the
mhm.
US, and that whatever China decides they want to do for the next year, they will do, because no one has choice. The corporations don't have a choice. The people don't have a choice. Anything Trump says, 1/3 of the population is going to think is idiotic. 1/3 of the population is going to think awesome. The 1/3 of the population that's trying to figure out whether it makes sense or not has trouble getting good information, because we only hear from the other two sides.
Right.
And so it is much harder for us as a nation, I think, to put these things in motion. And you're probably going to see a lot of people position against, and go pro NIMBY, because if Trump's for NIMBY, and they'll go, no, we have to protect our things. So they're setting themselves up for whether it's the midterms or the next set of presidential elections. So it's more chaotic here to navigate through this. So maybe I should have added that when you ask who's going to win. That is the one thing that's hard. Even if we have a great strategy, it is hard to implement, because first, U.S. corporations have their own risk responsibilities globally, not just to the U.S. And we have so much friction internally. It's sometimes very difficult to figure out where we're headed and what's the right answer, and actually get people moving in that direction. Despite the fact that I am very comfortable that when I travel across the country, I talk to corporations, I talk to some of the large states and municipalities, I talk to a lot of large asset managers. No one who I consider kind of decision-making people are that far apart on what we think we should be doing. Unfortunately, I don't think they're very well represented by DC, but
Uh-huh.
there is this, I think, overwhelming kind of consensus in and around the middle of what are the right sort of trade-offs. And yes, there would be some friction, push comes to shove, what you give up or won't. But I don't think we're that far. We can kind of unleash this middle.
Okay. God, I'd love to keep digging into this with you. I guess we're just going to have you back on again soon, Peter. But let me get back into the question I sort of asked in my intro here, which is, okay, all this is going on the trade side, right? Um, with trade, comes these tariffs, right? And the tariffs are making some goods more expensive, um, but they are also putting money in the coffers and the general treasury account for the government to spend, right? Helping us cushion the deficit a bit. Um, uh, and most notably, we haven't seen runaway inflation the way that folks initially feared. Now, granted, we're probably not feeling the full effects of the tariffs yet, but also too, hopefully, a number of these tariffs are going to get reduced, right? And that's a big part of what's going on right now with these live real-time trade negotiations. So, but I guess my point is tariffs don't seem to be the radioactive issue that they were thought they might be back in April. Um, we now have some trade deals in place and should hopefully have more in place soon. And pretty soon we'll have covered all the big countries that really matter, right? The 20 that you were talking about. We also have the passage of the big, beautiful bill. Whether you agree with it or not, it's now passed. And so the deregulation is taking effect. We also have some incremental tax relief beyond just extending the tax cut from the first Trump administration. So these are all things that are stimulative to the economy. And so do you expect at some point as we enter 2026 that we will actually start getting some material tailwinds from all this? Or are there other concerns that make you think, nah, that's too simple an assumption?
Yeah, so I think I'll play a little bit of devil's advocate here because I do agree things like the big beautiful bill can help, especially the accelerated depreciation, right? That goes hand in hand with what we've been talking about, this production for security, right? Oh, if I got to build new, property, plant, and equipment, accelerated depreciation helps a lot towards that. I would say the two things that make me less, comfortable is we've been getting about 30 billion of extra tariff revenue a month, 25 to 30 billion extra tariff revenue a month since only since May, really. So it's about 180 billion dollars of extra tariff revenue is coming through the system. So it's not that meaningful yet, right? And it's helped on the deficit, but it's kind of only cropping up. I also think the large corporations have avoided a lot of that because they have the working capital to get orders accelerated to get them brought in. So I think of the problems that are being faced at the tariff level are really small companies right now, mid-sized companies who are struggling. They tend not to show up in the data. I don't think our data captures the small and mid-sized companies as timely as we tend to capture the data from the large companies. We don't see it because we don't have to look at their stock prices. We don't get earnings announcements. So I think I think it won't be until Q1 that you start hearing a little bit more about this. I would say the other two factors to me that are very, kind of go hand in hand is, at least when I was in business, everyone had a couple quarters of things squirreled away. So even if tariffs were impacting you, you don't necessarily have to show it today because you're waiting to see where this all plays out.
You had some
And
cushion. Got it.
you had some cushion. And then finally, no one wants to say anything right now to attract this administration's attention, right? You do not want to go on your conference and call and say, I hate these tariffs, they're awful, because the next day something will happen to you potentially in the press. You'll get some, nasty social media tweet about yourself. So I think people are downplaying this and figuring out ways. And like you say, hoping the trade deals and stuff take, into effect. So I don't think we start hearing or seeing anything about tariffs until Q1. I think that slows it down. And in the meantime, I do think we have been seeing, some impacts from, the AI and the less hiring. I'm very, very worried about college grad jobs, where that's all
Mhm.
headed. And then, we had the recent bankruptcy of, I guess you can either call it Tricolor or Tricolor. That was probably directly a result of some of our migration policies, right? It was a company, as my understanding, was heavily dependent on lending in and around Texas. Many of the people there may have been, affected by the crackdown on migration. So, there's a lot of good, I think a lot of these things make sense. Having said that, there were people who are spending money. You look at, the talk about switching all these people to robots, and my gut fear is that everyone's going to cut back a little bit on spending coming into next year. There's still so much uncertainty, and your expense is someone else's revenue. And that, to me, I think that's why we're going to stay a little bit slow. I'd love to see this big boom. I'd love to see all these things turn into fruition, but we've also heard a lot of promises on potential future capital outlays, I'm not sure how much we've seen in terms of existing capital outlays. And when I talk to foreign corporations, despite some of what's being said at the government level, I think there is a lot of concern about putting property, plant, and equipment on the ground in the US after you saw what happened to the Huawei plant, Hyundai plant, factory. I would like to be more optimistic. I think there's a heavy drag on this economy. And if the AI spend cracks at all, I think we could see a problematic Q1, Q2.
Okay. In the Hyundai factory, that was basically sort of ICE coming in there and saying, "Hey, we think a lot of your workers here, there were a lot of them Koreans, but
Yes,
aren't legal."
yes.
Okay.
After Korea made a big investment. So I think, again, I don't know the details. We haven't seen much who turned out to be illegal, how many were here properly or not. But things like that don't encourage companies, certainly
Yeah.
don't encourage the workers to come over.
Yeah. Okay. All right. So sounds like in a nutshell, you said you are concerned that Q1 and Q2 may be softer than folks are currently expecting right now. Okay.
But
And
I'm
look,
not completely bearish or anything like that. I do
yep,
think yields will be okay. And again, the one thing we haven't talked about, I think Trump will ultimately cave on solar. I think he is being told by all his advisors that you really do need solar as part of this. I think they might be telling him about wind on that. I think he's going to fight wind much longer. He has a certain visceral, I think, hatred of wind, whether it's because it destroyed his views in his Scottish golf course, or I think partly he does not like the deaths that it causes with birds and things like that. But I think solar he's going to wind up having to accept. So I do like being a little bit overweight some of the solar names, partly because they do not trade very well. And by solar names, not the companies that lend against putting solar on your roof, but really the electricity or energy providers that are heavily solar, who their stock prices are low, they still have fairly large short interest. I think they will actually do surprisingly well as the need for electricity pulls solar with it.
okay. Um, Super interesting. Again, I'm biting my tongue. I'm looking at, we only have 10 minutes-ish left. So Peter, we'll have to have, like I said, have to have you on again soon. Okay, so I want to get to kind of a market outlook, but just for a second, um, we talked a while ago about concerns that could be voiced about whether the AI stocks are going to be able to, or the AI companies whose stocks are high flying are going to be able to grow their earnings enough to justify their current market valuations. If they can't, and I'm not saying you're predicting this is going to happen, but if they can't, that would cause a substantial repricing in that sector, which of course now makes up such a huge percentage of both the S&P index and even more so of the NASDAQ, that there would be a pretty big material general market correction, and that would have probably some negative wealth impacts that would slow the economy even more, correct?
Yeah, and that's why I think I'm kind of trying to be overweight, kind of these national champions, these things that I think are going to develop from ProSec, which clearly if the AI story fades at all, you're going to see electricity prices probably come down. So you'll see some of those stocks fade. So again, your lottery tickets probably get crushed, but some of the longer term plays I think do well. I think you want to own some of the small caps, some of the things that have been left behind. I've been starting to look, I don't have this on, but the equal weighted indices. And there are ETFs that you can do the equal weighted indices have really lagged behind the market cap weighted indices recently. So maybe you switch to, take some profits in the market cap weighted ones and switch to. So I don't think you want to be out of this market. I'm not that afraid of the world, but I do think you kind of want to look for those opportunities. And I think you want to dabble in some of the parts of Europe, whether it's Poland. I still like Poland. I think that's going to become a huge beneficiary of any rebuild.
Mm-hmm.
And I do think that this production for security is going to catch on globally. So I think there might be some value in some of the European energy stocks that haven't done as well as the U.S. energy stocks. So I kind of want to own heavily weighted to kind of ProSec kind of and the
Yeah.
left behind, less weighted to the big high flyers, precisely for that risk that you talked about. And I basically have cut all my exposure to China because I do think there's potential for more friction long before the 1 year ends.
Got it. Okay. Um, so general market call. I mean, I'm not going to hold you to this,
Yeah.
but I'm curious. Since 2022, which was a down year for both stocks and bonds, stocks have done very well, right? Plus 20% returns in 2023 and 2024. Definitely, unless something goes pretty wrong now, at least double-digit returns again here in 2025, right? What kind of what kind of year do you think the market's going to have next year? And I don't need necessarily a number, but it could be a, down year, slightly up, way up, kind of guesstimation. And
Yeah.
I'm guessing whatever you're going to say, you see that there's going to be, well, you think it's quite possible that there could be a pretty sizable capital rotation from these high flyers over the past few years into some of these other spaces like the ProSec.
Yeah, so I think you're going to see the outperformance from these other areas next year. I think they're going to outperform the high flyers next year just based on valuation and where I see the attention this government's going to. I see another potential for a double-digit returns. As much as I talked about some of the caveats, right? If these things all do click, right, and we really start seeing the government investment in ProSec lead to corporate investment in that, lead to asset managers chasing those things. And again, that's been one of the beauties, right, of the US is every asset manager is looking at some of these stocks that I've been talking about or those sectors and saying, wow, they've crushed it lately. They're up 30%, they're up 50%, they're up 100%, they're up 20%. Money will flow into that. And I think it can feed on itself, right? Again, the best of all worlds, right? Capitalism actually does allow capital to flow into areas that we should be growing. And so it won't just be the government putting money into that. So I think you could see really good growth. I think you can see corporate strategies in and around that to some degree, right? You could even look at the mags, the data center AI people, how closely they're aligning themselves to the electricity producers, right? They realize that their business is not sustainable unless they have, captive energy producers or very closely tied energy producers. So if that permeates, I think you have all those kind of, tailwinds going for you. You've got less investment, lower interest rates you're going to have. I think the 10 year is not going to get much above 4%. In fact, I think it'll probably get down to 360 or 370 early next year. So you're going to have those tailwinds. And if we can get these deals with other countries and kind of back off this whole friction, and China lets us go for the year without trying to stop us, I think we could have a great year. I also see a real solid chance of being down 10 to 15%. So I think I want to own some hedge strategies. I want to be careful every time I get excited. I want to look for some sort of optionality. But again, that's why I find some of those ProSec names more comfortable because I feel that their downside is much less than
Much
their
less.
upside.
Yeah.
And that's kind of why I want my portfolio. So even if I'm wrong about the upside story, I don't think they get hit as much on the downside.
Okay. All right. Hey, by the way, I appreciate you being so specific like this. All right, we're going to get to just rapid fire for the next couple of
Uh,
minutes.
okay.
And you've already answered one of my rapid fire questions, but anything else you might want to add to bonds and bond yields next year? Heard you say 10 years likely to go down maybe somewhere around 3.6. Anything else you want to say about bonds for 2026?
Yeah, listen to Besant. He says he wants 3%. We'll get to 3% on Fed funds. He wants sub 4%. He wants a 3% tens. I think they'll push it. I think people underestimate the willingness of the Federal Reserve to do things to keep yields low. I think they have Operation Twist, which we've done. And I will say, I don't think we get to yield curve control. And people are like, oh, why would we ever like? I think Bernanke got very close to yield curve control. Yellen got very close to doing yield curve control. Powell hasn't had to do it, but it is on their playbook. And if any administration is comfortable setting the prices, Trump talks about setting the prices for tariffs. He talks about setting the prices for Fed funds. I do not get, I think this administration with Bessent and Treasury will keep 10 years under control and we won't have some sort of backlash even if we cut rates. And I think that's one of the biggest fears out there that people have had that's going to be misplaced. And I think corporate credit's going to do fine. I think private credit might have some issues. It's small. It's not going to drag down the economy. Corporate credit as a whole is very solid. So I'm very comfortable with your fixed income portion of your portfolio, which allows you maybe to be a little bit more aggressive in your equity side of the portfolio.
Okay. God, I love you being so concise and specific. It's awesome. Oil.
I like oil. I think the commodity itself will only do okay. I'm reasonably convinced, and this might sound tinfoil hat, but I think it's reasonable, is that the Saudis will keep oil below 70 as much as they possibly can. They have a diminishing resource anyway, so it's diminishing in value over time. They want chips, so I think the agreement they have, whether it's implicit, tacit, or just wink, wink, is you sell us chips, we keep oil at under 70. I don't think they let it go below 50 because that starts hurting U.S. producers. But I think the real value is going to become on the companies that can refine and process energy, oil prices, natural gas. I think natural gas has a lot more room to run. I think the companies around that, I think you're going to see a lot of development in and around natural gas-fired electron production, and even
Because
coal-fired.
that'll be the
So,
bridge fuel for the data
right.
centers
Yep.
until nuclear hopefully comes
Right.
online.
Right. That's the 2 to 7 year backbone.
Yep. Okay, awesome. And the oil stocks are pretty beaten down right now, so presumably a good time to be entering.
Right. And that's why I love them. I think the hedge funds still don't like them. I think there's, shorts in them. And I think people have not understood that we are having a shift in what we think about in terms of sustainability and how important these are going to be to our growth and getting out of this morass that we've been stuck in.
Okay.
And by the way, the one thing, although it takes 5 years, say, to build, so let's call it 3 years to build a, gas-fired plant. That 3 years is going to require all sorts of construction material to build it. There
Yeah.
is going to be a huge amount of demand for these resources and jobs coming out of it, just like the data centers as they're being built. I think data centers actually create more jobs while they're being built than when they're actually built, but that's a separate issue. But yeah, there is that demand for these hard, raw commodities. So I think energy, all they do very well, they're still undervalued.
Got it. And I'm assuming I'm going to ask you about gold next, but I'm assuming copper would benefit from what you're talking about.
Gold, yes, I think all the industrial, they will all continue to do well. This growth is happening, and the only way I think it stops is if China really puts a clamp on their exports of processed and refined rare earths and critical minerals. Because I can't remember if I mentioned this in your last show. It's become probably one of my favorite quotations. Is it was during COVID, the CEO of Whirlpool went on TV and said, "Just as a reminder, a washing machine that's 99% is not done." And I think that's the risk with China's control of the rare earths and critical minerals, the processed and refined versions. Yeah, they're only a tiny component of many things. But if that tiny component doesn't get to us, we don't have a finished product. And so I think that's the risk to China. And that's why I view that this administration has such an urgency to alleviate that risk.
I'm curious, in the rare earth space, I mean, I know in the past month or so, the publicly traded companies that have anything to do with rare earths have just exploded, right? Because
Yeah.
everyone's realizing, oh my gosh, we've determined this is like priority number one. Um, Too late to get in on that or early innings still?
I still very early innings. I think you got to be careful. Again, some of the lottery tickets I've sold, some of those out, I'll be reloading, but I would want to focus on those who have processing and refining capacity, right? We can still buy, like China does not produce all of their own rare earths and critical minerals, right? They refine almost the entire world. So I think they have about a 60 to 70% control over the rare earths and critical minerals themselves, but it's the 90% on the processing and refining. We completely seeded it. We all closed our eyes and said, well, it's a dirty process to, refine these things. So we'll give it to China so it's not so dirty. And I think that was insane. So we have
Right.
the
Just like
ability
we
to,
gave them all our plastics and they just dumped it in the ocean. But yeah.
right. Yeah. So we were worried about plastic straws and they're, destroying the universe very quickly. So I think that's where I want to be is who has some sort of technology or an edge around that, refining or processing. And again, I think the nuclear story is even easier. Who's going to be supplying the uranium? These things are going to take time to come up. But I think what the government's trying to do is, ramp that up through what they're able to do on federal lands to get those economy of scale. So I don't think it's too early at all, or sorry, too late at all. I think there's still plenty of opportunity.
Okay, great. Gold.
I don't really touch that at this stage. I've lost track of, where it is. It's been a phenomenal investment for the people who are involved. Overdone to me, possibly. I think so. I think this, but I don't have a good enough sense on that, and I've given up following it. It's kind of not a part of my portfolio because there's certain things you just realize I get wrong all the time, so I'm just going to ignore that part.
All right. Hey, I very much appreciate that in a capital manager, somebody who just says, "Hey, look, this is my zone of expertise. This one isn't in it right now. Don't use me as your source on this." All right, Peter. Look, this has been fantastic. We're at the end of the time here, but thank you so much. For folks that would like to follow you and your work, where should they go?
So they can go to our website at academysecurities.com. They can find a bunch of our research out there, or you can follow me on Twitter at TFMKTS.
All right, fantastic. And Peter, when I edit this, I will put up the link to your website and your Twitter handle there on the screen so folks know where to go. Folks, the links will be down in the description below this video as well. Folks, please do me a favor. Join me in thanking Peter for being so generous and specific with all these details. let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you are a DIY investor and really like what you've heard from Peter here, then definitely go to his website and avail yourself to all the resources there. If you're not a DIY investor and you are inspired by what Peter talked about here and would like to get some professional help in answering how you might be able to put some of these ideas to use in your portfolio, I highly recommend you get that advice from a good professional financial advisor, importantly, one who takes into consideration all the topics that Peter has mentioned here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you just like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful as possible. Peter, thanks so much. It's always wonderful talking to you. It's going to be really interesting to see what happens in 2026. We'll get you back in Q1 to provide an update for us. But in the interim, best of luck. And again, really appreciate everything you shared with us today.
Thanks very much. And sorry about the early audio issues.
Hey, look, that's sometimes just Murphy's Law. And I think we did a good job correcting it halfway through. All right, Peter, thank you so much. And everybody else, thanks so much for watching.
Russia, China, and now India. Global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system.
The trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by. $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond.
Central banks, especially in India, Russia, China, and other global South nations, are boosting gold reserves while cutting U.S. treasuries, marking the first time since 1996 that gold has surpassed treasuries. India alone has reduced its T-bill holdings to $227 billion, while raising gold reserves to about 880 tons. Meanwhile, Eric Jung predicts that with gold hitting record highs above $3,500 to $3,600 per ounce, forecasts project $3,700 to $4,000 by mid-2026 and potentially $5,000 plus if Fed independence is challenged and a wider shift from treasuries accelerates. So the U.S. can revalue its treasury gold reserves at much greater market levels. Eric Jung is a financial commentator and analyst who frequently discusses gold, silver, and macroeconomic trends. He highlights that gold consolidated for months before breaking above $3,500, while silver pushed past $40. Many dismiss the idea that Trump's tariff threats explain this move, since that narrative has been recycled for months. What really drove the breakout was the recent BRICS meeting and India's shift, reducing U.S. Treasury holdings while increasing physical gold and silver. Combined with America's ballooning $37 trillion debt and talk of confiscating frozen Russian assets, these pressures pushed India further toward hard assets and away from treasuries. This reflects a much larger global trend. Countries like Russia, China, and now India are abandoning U.S. treasuries and adopting physical gold as a reserve asset, signaling a fundamental change in the financial order. Unlike treasuries, which can be frozen or seized by Washington, physical gold held at home cannot be cancelled by a foreign government. Eric believes as a result, sovereign demand for gold is accelerating. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
Gold, I think, consolidated for around 5 to 6 months, and it broke out of 3,500, so $3,500 US dollars per troy ounce, and silver went beyond $40. I think that was the top it made several months ago. So it's now above $40 US dollars per troy ounce. And I know the mainstream narrative of all this is that the tariffs, the Donald Trump tariffs, potential tariffs on gold and silver is not clarified, but I don't buy that because they've been using that narrative for over 6 months. I mean, how stupid do they think the authorized participants are? Bankers are, right? This is ridiculous. I think what really happened is BRICS happened, like that BRICS meeting that just happened, and what happened in India. I don't know if you know, Danny, but the Indian central bank is now reducing their U.S. Treasury bonds and T-bills holdings and increasing gold, physical gold, and guess what? Also silver, physical silver holdings. Okay, that's why I think, in my opinion, that's why gold and silver broke out of the trading ranges. Donald Trump, but it's funny that it just seems that nothing that India does pleases Donald Trump. And Donald Trump came back with a 100% or more tariff on India. So I don't know. I think it's as simple as that. It's just like somebody is trying to be nice to Donald Trump, and Donald Trump instead slapped additional tariffs on that country, and therefore that country is pushed over the edge. And now, they are reducing officially their U.S. Treasury bond holdings. But I think the underlying reason, Danny, is we've said this before. Two things. Number one, look at the U.S. national debt, $37 trillion in counting. $1 trillion of additional debt every 3 to 4 months. Okay, so this ain't gonna stop. Number two, recently the EU is supposedly potentially going to be pushing the button to confiscate the frozen Russian assets. Okay, that they froze, when Russia started that special military operation in Ukraine. So I think combining all these different, factors just really gave India the extra push to push that button to let go of the U.S. Treasury bonds and T-bills and dive in officially into gold and silver. Then recently, gold just shot up and exceeded U.S. Treasuries. So I know a lot of people make fun of this, but what that tells me is that led by the global South, Russia, China, and now India, um, you know, uh, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system. Because going forward, I don't see there's any, significant steps of this trend in reversing. Simply because in a multipolar world, physical gold is not controlled by any individual country. Nobody can just push a button and cancel the physical gold that, let's say, India, China, and Russia hold at their, domestic vaults. Okay, but let's say if you hold a lot of U.S. Treasuries and you piss off Uncle Sam, somebody like, I guess Bessent or Jerome Powell, whoever, can go back to the office, push a button, and buy. Your stuff is frozen, or worse yet, it's going to be confiscated, or deleted, or whatever, right? So I think, like I said, the flight to physical gold at a sovereign level is not going to stop. It's simply going to accelerate. And physical gold, like Francis was saying, is just at its beginning phase of being remonetized. And it's going to accelerate going forward.
Francis Hunt, known as the market sniper, along with Eric Jung, points out that central banks remain steady net buyers of gold, with India notably reducing U.S. Treasury exposure while increasing its gold reserves over the past year. Analysts warn that even modest reallocations from treasuries into gold, potentially in the hundreds of billions, could drive prices sharply higher, given tight liquidity and the outsized impact of institutional flows. Forecasts suggest gold could reach $3,700 by end 2025, around $4,000 by mid-2026 in base cases, and near $5,000 in stress scenarios, expanding its market cap from roughly $24 trillion to over $31 trillion. This shift is driven by geopolitical tensions, rising U.S. debt, and concerns over dollar-based assets being frozen or seized, making gold the preferred non-sovereign reserve asset as nations diversify away from treasuries. Let's just get back to the interview.
What percentage of that is losses in treasuries as well and gains in gold, which further eggs the point rather than saying that there's no one selling. But people don't like to accumulate an asset that is losing value, and they double down and accumulate assets that for the extended future they see as accumulating value. No one gets fired for buying gold or for hiring McKinsey, they used to say. I don't think central bankers, and it also puts something else. I'll throw two other thoughts in on that chart, which I love, and I'm glad you shared it. I saw it as well. There's no chart for it, but I can tell you those nations that are accumulating and also seeing appreciation in their gold whilst not adding to their treasuries and watching devaluation, they're also not choosing Bitcoin. They're choosing gold. They're choosing gold predominantly here. And that tells me there's a very Americanized probable stigma in terms of the potential creation, because there's been no embracement by institutional central banks in the Deep South or the Grand South or the Global South and the BRICS nations in terms of Bitcoin on a meaningful basis. They accumulate it where they have a criminal who's trading in stolen cars or something, right, fine, and they hold it. But there's not a net accumulation on that side as well. So I think when you look at the big money that knows, the big money has spoken and the winner is gold. And the appreciation will be far more safe in a less volatile way, and you won't have to watch an 80% cycle deval or 75% one if you miss the perfect selling point either. And people need to remember those key aspects about Bitcoin and gold, and why I think gold is the winner. It's the safe hands for everyone. Yeah, in terms of the market cap as well, again, because don't forget $1,500 extra on the gold ounces. That's actually in percentage terms from 3.5. It's almost like another 50%. It's probably around 35 to 40%. So you would go from 24 trillion plus another third. You'd add another 8 trillion on that, and you'd be at 31 trillion. So I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond 50 and beyond. Eventually, my feeling is that whatever the debt market was at its high point, the amount of money we felt existed at its biggest bubble of the debt market, we end up seeing that deflate, and by however much that deflates, gold goes up, because there's really only one trade for me. What do? You don't buy real estate that's already leveraged with debt at ridiculously high prices. You don't chase a hyper overvalued record PE stock market. Some people will, and there will be elements. But when this is fully played out, the natural approximate geometry is however big the trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by.
The accelerating move by central banks, especially in India, Russia, China, and other global South nations, away from U.S. treasuries and into physical gold signals a historic reshaping of the global reserve system. With gold breaking record highs and forecasts pointing toward $4,000 to $5,000 in the coming years, the metal is regaining its role as a core anchor of financial security, driven by sovereign demand, geopolitical uncertainty, and distrust of dollar-based assets. Could a mass revaluation of U.S. Treasury gold reserves at higher market prices fundamentally reset the global financial system? How might continued BRICS diversification into gold and silver impact the long-term dominance of the U.S. dollar? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
It means that the government has to start building stockpiles. And so it's another buyer, and it's a big buyer. This is a really big buyer. But again, this will also, like, who else uses silver? Companies like Tesla are going to have to start stockpiling now because they will know that there are higher prices in the future. Well, anybody that uses a lot of silver in production of goods needs to take a position now and protect themselves from triple-digit silver and gain that same leverage over their competitors. This has the greatest gains in absolute purchasing power. And that is what matters, is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing.
Since the government must now build silver reserves, it becomes a major new buyer in the market. At the same time, companies like Tesla, which rely heavily on silver, will likely start stockpiling as well, anticipating higher prices ahead. Any business that uses significant amounts of silver should secure supplies now to shield themselves from triple-digit prices and gain a strong edge over competitors. Mike Maloney is a renowned precious metals expert, educator, and founder of goldsilver.com. He explains that governments always find ways to tax people, either directly or through inflation. History, like Weimar hyperinflation, shows how war spending and money printing quietly destroy wealth until it's too late. As people save in fear, devaluation builds, only to erupt in sudden inflation when money flows back. Gold-backed systems once restrained this, but fiat currencies lost all discipline. Today, massive money creation and QE enrich the elite while draining ordinary savers. Gold remains undervalued, but the system will eventually face a reset. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
True, but the problem with government is they will just tax us more. Silver could go to $1 million an ounce, and they're just going to take as much as they can from the population in two methods: the regular tax and inflation tax. And as they print for war, I did a lot. When I was writing my first book, my study on the Weimar hyperinflation was a stack of books about a foot high. And so I had assistants. I didn't read all of them. I'm dyslexic. They read them and they highlighted stuff for me to look at. But we did a very intense study on the Weimar hyperinflation. During that, with World War I, when there's war on your soil, you have a lot of anxiety, and every dollar you earn gets saved. So none of it is in circulation, and it allows the government to keep on printing and printing and printing, and you don't see the dilution of the currency supply. You don't see the devaluation of the currency until the war ends and the anxiety is lifted. And the minute some of that currency comes out of hiding, back then you would stick it under your mattress, not put it in the bank. But once it comes out from under the mattress, look out, you're in for a hyperinflation. And so, yes, it'll make war more expensive. But if we are having war, the population will start doing more saving, velocity will slow down, and the result is that the government can very secretly steal a majority of your wealth without you knowing it until it's too late. And that's what using gold used to do. And then we went from 100% reserve ratio. First we had gold. Then we had gold notes, 100% backed. And then we introduced the Federal Reserve, and it was 40% backed. And then the Bretton Woods, and it dropped eventually to 8%, but there was no specified reserve ratio. But gold standards opened the door for this scam to all happen again. And so I hope we don't end up, I can tell by what countries are doing around the world that we are headed towards some sort of monetary system that has gold connected to it. Is it going to be another gold standard, or will the citizens of planet Earth wake up and say, no, we're going to use something real and that stores value? And fiat currencies have proven that they don't store value, and mathematically they can't.
Mike Maloney highlights that when manipulation breaks, the free market always wins, whether under fiat, digital currencies, or any system. True wealth isn't measured in unstable prices but in value relative to real goods like gold, oil, or wheat. Fiat money and floating exchange rates distort prosperity, stealing lifetimes of potential growth. History, like Weimar Germany, shows how loss of confidence leads to hyperinflation, where people rush to trade currency for anything tangible. In such times, gold rises faster than everything else, gaining real purchasing power. Today, with gold up nearly 50% this year, outpacing real estate, stocks, and even Bitcoin, it's clear that value, not price, is what matters. Now, let's get back to the interview.
Yeah, and that explosive phase change is when the free market overwhelms the manipulation, and it always has and it always will. It doesn't matter if we're in some digital currency system. It doesn't matter if they lock us in a jail cell and put us to work and extract wealth from us that way. It doesn't matter even if it's the matrix. The free market will overwhelm it. You and I spent a lot of time creating a chapter for the great gold and silver rush of the 21st century. And it's something that I dubbed Wealth Cycles back in 2010, I think. And we measured like everything that we could measure where we could get data that goes back into the 1800s. And what we discovered there, what's going to happen? Yes, the old measurements, if you're using currency. Ratios? No. It's impossible for the ratios not to stop working. Once you use ratios, you are getting rid of the currency. That's being taken out of the equation. When you measure your house value of your home in barrels of oil, ounces of gold, bushels of wheat, tons of iron, pounds of copper, shares of the Dow, when you do that, you start seeing what true value is, not price. We have to stop measuring things in price and start measuring the value of things. Steve Forbes, there was a great animation that our animator Aiden did for Steve Forbes when he was in Hidden Secrets of Money. And he talks about, what if the foot changed every day? So 11 inches one day and 14 inches the next or whatever. Or if you're trying to bake a cake and the clock change, a minute is 40 seconds one day and 90 seconds the next day, things become impossible. Well, that is the US dollar. And all these floating exchange rates severely limit our prosperity and has stolen part of our lifetimes. You can absolutely prove that when you create greater prosperity, a population will live longer and be happier. This is just fact. And so, and you cannot go back in time and repair transactions that didn't happen or prosperity that didn't happen. And so these fiat currencies, these floating exchange rates, have shortened your lifetime and my lifetime. They absolutely have. And this is something that is provable. I had you insert a chart after this of the Weimar hyperinflation, simply because this looks like the Weimar hyperinflation. Yeah. Now, if you look at that early part from the end of World War I up until the beginning of 2020, if you make a chart of just that, that is it's a pre-hyperinflation hyperinflation. I remember we were interviewing Jim Rickards, and I I was telling him I had discovered this pre-hyperinflation hyper, and I was all excited about it. And he goes, I didn't know I was here for a history lesson. So anyway, that first phase was a conditioning that happened to the population. That loss of 90% of their purchasing power. This is a 90% loss in purchasing power. Taught them that if they hold on to currency too long, so the second time that they saw this happening, that's when they started buying anything. A case of doorknobs will hold its purchasing power better than the currency. And so that's what caused that change in public perception and the introduction of fear of holding on to the currency for more than a few seconds caused that end game hyperinflation. But the point is that gold is going up faster. Every chart looked like this. Real estate looked like this. The stock market looked like this. Everything in Weimar Germany looked like this, except gold was going up at a factor that was greater than all the other things. So it was gaining in purchasing power during this. And it was in my first book. Go back to the Japanese yen chart one more time, the tab before this. And Japan has been stuck in basically a deflationary environment or stagflation during that whole period of time. Prices of real estate and stuff are not keeping up with gold. If gold quintupled, it's probably tripled or quadrupled in purchasing power of real estate, businesses, and anything else you want to buy. Cars have not quintupled since 2007. So that's a real good measurement. How much is a car since 2007? Has it doubled? Well, that means you can get 2.5 times more cars with your gold than a year. That's since the beginning of the year. So we just started the 9th month. Yeah. Yeah. Is there anything else going up this fast? And the answer is no. It's at this point for this year, this has the greatest gains in absolute purchasing power. And that is what matters is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing. And so that means that this is gaining in purchasing power against everything else.
Both governments and businesses are gravitating for hard assets like gold and silver due to pressures from debt, war expenditures, and currency devaluation. History tells us that true worth endures while fiat regimes inevitably fail. Gold is outperforming almost everything, and manipulation flaws are already visible, so the trend toward material wealth is quickening. Do you believe that governments will be able to conceal inflation this time, or will hyperinflation erupt like it did previously? If governments and large corporations began hoarding silver, how high could it actually rise? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates.
With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Colin Weiss wrote in Official Reserve Revaluations, The International Experience on August 1st. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Noting this scenario, the speaker, Clive Thompson, highlights that the Fed isn't guaranteed to pick a revaluation target of $15,000 per ounce. They might even use the spot price instead. The Federal Reserve published a research note titled Official Reserve Revaluations, The International Experience. The paper examines 5 countries, Germany, Italy, Lebanon, Curaçao, Sint Maarten, and South Africa, that have revalued gold or foreign reserves to bolster their finances. The Fed has not committed to a specific revaluation figure, such as $15,000, using market prices, is still on the table. The study examines how other central banks have utilized revaluation proceeds to offset operational losses or provide government financing. However, the US has yet to take such a step. If revaluation occurs, then this paper profit could be converted into gold certificates and handed over to the Fed. The Fed could then credit the Treasury with new dollars, allowing the government to spend without officially increasing its debt. This is why some refer to it as a hidden financing tool for the state. Central banks have different methods for valuing their existing bullion holdings. Some value their gold reserves at their historic cost, others report it at current market prices, he said. When central banks report their holdings at current market prices, fair value, the unrealized profits or losses from valuation changes are recorded. When gold is valued at historic cost or modified historic cost, gold reserves can be revalued at market prices or values closer to market prices to generate revenues, he noted. When all official reserves are valued at market prices, the unrealized valuation changes recorded in the revaluation account can be shifted to others. Now, we present the clips from the interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want to, well, they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary. Not much. I mean, let's face it. With the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Francis Hunt, also known as Market Sniper, points out that a significant revaluation of America's gold reserves could instantly boost the federal balance sheet by recognizing hundreds of billions in previously hidden assets, thereby improving the debt-to-asset ratio and bolstering confidence in U.S. bonds and the dollar. By providing extra backing for government obligations, it could help address record-high sovereign debt, while reinforcing gold's role as an inflation hedge, signaling limits to currency debasement and strengthening trust in U.S. monetary stability. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. Financial markets have operated for decades under the assumption of fiat currency dominance, and an essential shift in monetary policy could lead to substantial volatility across asset classes. Revaluation might paradoxically create inflationary pressures if implemented too quickly or without careful communication. The sudden recognition of additional national wealth could alter inflation expectations and lead to accelerated price increases in the short term. Major gold holders, such as China and Russia, who have both been actively increasing their reserves, would likely react with deliberate actions to capitalize on a more gold-driven monetary environment if the U.S. were to revalue gold. A comprehensive legal and regulatory foundation would be required for such a change, including congressional consent, coordinated action by the Federal Reserve and Treasury, and a clear implementation strategy. The foundation for this strategy may already be in place, according to recent Treasury remarks on asset monetization. Growing awareness among financial professionals and officials highlights gold's potential as a significant instrument for addressing America's debt issues, although the timing and scope of any adjustment remain unknown.
What does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into pharma shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show. When you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the Liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark to market is far more likely. And the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do, but they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt, and they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
A revaluation of US gold might reveal enormous latent value in the country's reserves, enhancing fiscal stability, fortifying the dollar, and indicating a cap on unrestrained currency production. To prevent market turbulence or inflation shocks, such a move would necessitate rigorous coordination between the Federal Reserve and Treasury, a precise legal foundation, and a well-managed communication strategy. The ramifications would be seen globally, changing monetary policy and potentially hastening the transition to a financial system that is more heavily reliant on gold, with big gold-holding countries like China and Russia ready to react strategically. What short-term effects may a gold revaluation have on international financial markets? What legal and practical measures would the United States need to take to carry out such a revaluation? Please leave a comment below with your comments on Clive and Francis's gold revaluation analysis. If you find this video helpful, please give us a like and turn on notifications to stay up to date with our latest videos. I'll see you in the following video. Thank you for viewing.